Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, we have to have a conversation. We got some serious cracks in the dam. We're going to explain exactly what they are. You're not going to want to miss this. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
Bob or Houston, we have a problem, don't we?
Yeah, it's this is like the slow motion train wreck. I don't know how they could keep hiding this stuff, but what we're going to talk about today is really the deterioration in credit. And then tomorrow we're going to explain to you why we're having a deterioration in credit. But let's start off with this first chart. The credit card default rate, Phil, is now exceeding any level since the 1990-1991 recession. And you got to remember that recession came about from the savings and loan crisis, if you remember. And so I think people are giving up, okay? I think people are giving up, Phil, and they're charging their cards up till they max out.
Yep.
And then they're going to walk away.
Yep.
And that's a death knell. Remember, that was probably the last area of high income for banks is credit cards. They're charging penalty rates at 29% for people, but once people start defaulting, they can give 2 bits about what the bank charges them. They're just going to walk away from the loan. But it's not just the consumer that's struggling, Phil. Take a look at the delinquency rate in multifamily housing. They've overbuilt these dogs, okay? And now they can't fill them. Where I live in Laguna Niguel, California, you can't get a single family home. They're just snapping off the market. I was telling people in the room that if people get wind of a house, they're just gone off the market. But they built all these multifamily units, okay, and they're charging way too much rent for them, and the occupancy rates are atrocious right now. And what's interesting, this with the delinquency rate on multifamily housing being this high, Phil, you got to remember a lot of these multifamily projects were built with pension money and hedge money with no debt at all, and you're not getting any of the occupancies that you would need to get yield for your investors. And so I think we're going to get a twofer on this. We're going to get, again, bank problems, and number 2, people are going to be bailing out of these hedge funds, and people are going to be gated. I told a story before. My mother-in-law got caught into a medical building multifamily fund. It took her 6 years to come out of the gate just to get her money back. Okay, she had to go through a recession, and on the other side, before she got her money back. Forget about the yield that she thought she was getting on these things. So you got to stay away from anything that's not liquid, to the point where you can't wake up in the morning and hit your Schwab account and get out of. Okay, because we're at that point now where liquidity is going to move to solvency, Phil, and it's going to be a big issue. But I think this is going to lead into some short-term deflation for us, because they're going to get desperate. They're going to be starting to offer all kinds of specials and deals and reductions in rates, especially if you're in a B or C area, that people are going to be demanding better prices. My daughter, she's living one more year where she's going to live, and she said that they check every week to see rental rates. She said in LA you couldn't get studios for anywhere near affordability. She said now they're dropping studios in LA at $1,600-$1,800 a month. There used to be $3,500 a month for studios. So now, no way living in LA. LA has different problems, but you're starting to see softness even in areas that just didn't have any availability. Vacancies are starting to show up. So it's a big problem here in credit.
Yeah. And, all of this starts with the lower end of the consumer spectrum, right? So your subprime area of consumer, just to flip back to the credit card defaults, you'll notice that this is among banks that aren't the 100 largest in size by assets. So, this is what you tend to see as you're getting your first signs that the economy's slowing down. And that's why this chart's important. Later on, the bigger banks will start to reflect this as well. But if we go back to the delinquency rate of multifamily housing, I'll tell you what's concerning about this for me, Bob, is that we don't even have a recession technically yet, right? I know you and I both know parts of this country are already well into one. But in terms of what they need to see in terms of unemployment rate, we're not technically there yet. What's scary about that is that means that we're basically, if you look at the '08 section, we're not even in the recession. So does that mean we're going to see a spike like what we saw from '08 to 10 then on this chart, and we're going to go to heights that we've never seen before on the delinquency rate of multifamily housing, and that's going to play out over the next 3 years? So we say, oh, wait till next year to buy a house. Maybe it's more like, if you really want a deal, 2026, right? So that's what's concerning about this. And I think if you're making a living off of real estate as a broker or something like that, I would be getting really defensive and making sure that if I need to, I can basically limp through the next 18 to 24 months. I definitely wouldn't be buying into this market. I'm still seeing, we were talking today, right? In your neck of the woods is still relatively hot in some areas. I just wouldn't be buying into here because, you're going to be buying at the tippy top. It's going to take you years and years to recover any equity in that property here. So it's, that if there's nothing else to take away, is that not the spot to buy. Wait if you're looking. And I think you actually are going to see some deals that we haven't seen in a long, long time in real estate.
Yeah, the thing about it, here's the career path of a commercial broker. He's a commercial broker. He gets laid off. Hey, go program. Oh, AI took your job. Oh, work at McDonald's. Robot took your job. So, this is going to be the wheel of employment for a lot of people, and I'm not disparaging realtors, but it's not really a skill position other than communication and endurance, right? So where else are you going to go? What else are you going to do? And I feel really bad because a lot of these people, made decent money over the last couple of years, but you get to see the deterioration. 21 was the peak. And from there, I think, and the interesting thing about it, we talk employment, we're going to talk about that tomorrow. It's going to be peace and safety and sudden destruction because companies, especially when we get to the year end, when they start washing their hands, it's going to be a Pontius Pilate moment here. People are just going to be dumping everything, clearing the balance sheets, getting rid of people, doing the charge-offs. And I think people are going to be absolutely shocked at the unemployment rate, where it's going to go, and also the sustainability of the unemployment, because I just don't know where these jobs are going to come from in the short term. It's going to be really, really, really interesting to me. But with that, Phil, guys, you want to trade with us? There's some really, really, really cool stuff coming out in the ETF world that can make you just not care what the market does. We're on top of it. Really cool stuff. We happen to share it with you. And Phil and I are still in the belief short term that this move that we're seeing in the market is going to result in some sort of spike high this summer. So that's our view on this. And we're seeing that being vindicated in certain areas already. Energy already started to make the move. SPY's making a move. We're going to watch some of these underlying start to move as well. And then that's going to be your opportunity to get defensive as the summer rolls on. But with that, Phil, that's all I have for today, guys. You get the last word.
Have a great weekend. We'll see you guys on tomorrow's episode.
Trade Genius.